Thanks, everybody. Good turnout. We like to see people interested in getting the updates. We're going to talk about a few things, some legislative updates, uh, um, and we're going to talk about some changes just come every year with the filing season changes. And then we'll get into some forms, some new forms because of some new provisions and some changes, and then changes to the existing forms as we go in that. So legislative update. The first thing is the big thing. Senate Bill 399 from the 2021 session is simplification of our tax system, and a little bit of history on that. Montana has always had what in the industry is kind of called automatic. We automatically conform with the federal legislation, meaning if the feds have whatever the law they have is what we follow. Now that is this has been the starting point. Um, Throughout the years, the Montana legislature added a lot of additional deductions, different treatment of things, and that, and it got to be where it was quite a heavy lift to go from your federal adjusted gross income to come up to a Montana taxable income amount. Quite a number of adjustments in that. Um, Senate Bill 399 came in and is trying to keep that more simple. And so what we have is and we'll get into what this means a little bit, but starting with federal taxable income is going to be the baseline with that. So, um, is that the big change you're going to see is that the Senate Bill 399 calls for following what your federal filing status is, and that includes single, head of household, married, filing jointly, all those different statuses. That will now be your status for Montana as well. They did implement different tax brackets for head of household and joint filers. You'll see the numbers on those later in the presentation, but that's how they accomplished that. As you might recall, Montana had allowed married couples who filed a joint federal return to elect to file separately for Montana because we only had the one tax bracket. Again, because of the adding the tax bracket for joint filers, that's no longer an option. So married couples will file a joint for Montana if they file a joint federal return. Um, some of the other changes that they did is in going with federal taxable income as the starting point. Um, they did. It does mean that you now follow the federal standard deduction or itemized deductions. If you itemize federally and take state income taxes as part of that, that is to be added back. That is part of the legislation uh, that they passed. But other than that, it will be the same whether you take itemized deductions federally or standard deduction federally. That will be what your deduction for Montana is as well. So no need to worry about dependents, different personal exemptions on the Montana compared to the federal in that. So it may mean that we should have fewer filers with that because of the thresholds, and we'll see those in a minute as well. As I mentioned, they created new tax brackets. And what they did was they took the first six brackets, condensed them into one, and that's at 4.7% now. And that's on the first 20,500 for single filers, and it's higher levels for head of household and joint. And I'll show you those a little bit later in the presentation. Um, Anything above that 20,500 for single is at 5.9%. They that so that's what you'll see for there. And again, that's a little bit higher number for joint filers and that. So that's what you see. It's basically some lower rates and higher threshold before you have to file. A separate piece of legislation um, led to us having Montana now has lower tax rates for net long-term capital gains. This is very similar, almost identical to the federal calculation. It's there. We'll have those rates here also later. In that, it's they repealed the 2% capital gains credit in favor of these rates. The tax effect is essentially the same on that. So you'll see that. But as I mentioned before at the start, Montana had used the federal adjusted gross income as a starting point, but then we had a lot of different additions and many, many different subtractions. Senate Bill 399 as an added or eliminated a number of those subtractions in favor of the higher filing threshold. So some of those subtractions, even though you've lost them, you won't have may not have to file, or your taxable income is still going to be lower because of following the federal standard deduction. But some examples of the subtractions that were repealed: unemployment compensation, we used to allow some of that to be subtracted out. Tips and certain industry workers, they're those are no longer a subtraction for Montana. This is a good place to note that, as I mentioned at the start, Montana still does conform with the federal legislation automatically. And so if there is some changes in the federal tax law to provide a subtraction to exempt out tips, Montana would follow that as well. But for now, that subtraction has been repealed, specifically at the state level. So that um, there were a number of several subtractions that were kind of aimed at retirees, and that the partial interest exclusion, the pension and annuity exclusion, certain deductions for IRAs and such. Um, Again, those were repealed in the interest of simplification. They did add a single subtraction for taxpayers 65 and older. It's $5,500 for the 2024 year. It does change with inflation. And a married couple who are both 65 or older can take the 11,000 on that. So um, again, it's removes some of the things that were called for in the law in the interest of simplifying it. Um, those of you who've prepared returns probably are familiar with how much fun it was to do the partial pension annuity exemption amount. It was quite the computation, and really was kind of for either you got it or you didn't. It was kind of that. So that's gone. They did repeal several subtractions for some of the savings programs. So there's the first time homebuyer savings account and the Montana farm risk management accounts. Um, they repealed those as a subtraction. You can still exclude some of the income on those accounts if you're reporting it in your federal income. Um, and you can maintain the account for the life that as it was at the time that the law was repealed. So for instance, the first time homebuyer account said you can put money in and set it aside, but you have to purchase a house with it within 10 years of starting the account. That's still the case. You still have to do that. But there's no subtraction for additional amounts that you put in there in that. Same with the farm risk management account. Some other smaller things that you'll see, certain workers' comp was exempt. That's no longer a subtraction. Um, Certain student loan repayments, again, those were all done. Um, One note is if you have somebody receiving or yourself are receiving Social Security and you had to recompute your how much was taxable to Montana compared to the federal, that's no longer something you have to do. So that's another way that things get simplified in that. Um, Another thing that the legislature did, primarily as part of simplification, but also as just they routinely look at tax credits to see if they're still effective, if they're doing what they need, if it's worthwhile to keep them, and that. And so quite a number of tax credits were repealed. The adoption credit that was the $1,000 per adoption, that was repealed. They did replace that um, with a more generous one that is $5,000 for a standard adoption, 7,500 if you adopt a child out of the foster care system. Um, and those are refundable now. The previous ones were not. The adoption credit, you could take that. I'm sorry. The old adoption credit just was, again, it was $1,000. Some of the others that were repealed, a lot of the energy and recycling credits, or excuse me, let me correction there. They kept the recycling credit, but a lot of the alternative energy incentives were repealed. Some of those did contain carryover provisions so that if you didn't need to use the full amount in the first year that you created the credit, you could carry it forward for a number of years. That's still in place. You can still carry over any excess on that, and that applies to some other credits that were repealed. There's some biodiesel credits were ones that were also that way. Um, just looking at a list a little bit of some of the others that were repealed, health insurance for uninsured Montanans, some of those were repealed. So again, what you'll see is there's a lot fewer additions and subtractions. We're left with a few that the legislature wanted to maintain, some new ones that were passed, and then others that are based on legislation that's outside our control, so federal legislation. So tribal income is still exempt, um, assuming certain qualifications are met. The interest on the federal obligations, that's backed out as well, um, and that. So um, I mentioned before that if you itemize federally, you'll take that on your Montana return. However, they did say you cannot deduct state income taxes, and that's just been standard for years and years and years. Um, so you will have to add those back to come to as part of coming to your Montana taxable income. Now, you do only add them back to the point where you get to where your deduction amount is equal to what your standard deduction would be for that filing status. So you're not going to lose, you wouldn't lose out on that. So that's what the simplification uh, tries to do. Um, Couple other things that were changed. Montana piggybacks off the federal earned income tax credit. They increased the percentage to 10%. It's still maintained that there's some you may have to make an adjustment because of some income that's not taxable to Montana but is federally in generating the credit. But that's what you have. Um, with the simplification, this is a good slide to note. You The requirement is that if you have to file a federal return, you have to file a Montana return. Now, you don't have to file a Montana return if you're not filing federally, unless you have either some sort of addition or some sort of adjustment still that puts you into the positive taxable income situation. So you'd compute your taxable income as if you were going to file a federal return and then make those Montana adjustments. If that results in a positive taxable income, then you do need to file a Montana tax return. The other reason that you may be filing a Montana tax return without having to file a federal return is to claim certain credits, the earned income credit being one of them. The 2EC is one that you'll also need to file a Montana return. Even if you don't have to file a federal return, you have to file a Montana return to get that. And so I'll talk about some of those changes a little bit with that. So when we get to the forms portion of it, one piece of legislation that was in the last session was addressing military retirees, and my experience with the legislature is that for a number of years and sessions they've been trying to implement something to give a benefit to military retirees. And this last session, they were finally able to get this in place. And what this is Montana residents who are military retirees and still working, earning income in some manner, um, are eligible for a subtraction of that military retirement. And so it's the lesser of 50% of your military retirement income or your working income, your Montana source wages, business income, and such. So examples that help with that, if you had say 40,000 in military retirement and were working a part-time job in the summer or something, it would be earning about $5,000. Your subtraction would be the $5,000 because that's the lesser of half of your military retirement or your working income. If you had a little bit different set of numbers, let's say still the 40,000 in military retirement, but we're working full time and earning $60,000, let's say, your subtraction would be the 20,000, which is half of your military retirement. This also applies to um, survivor benefits. So if somebody is a resident and receives military survivor benefits, um, those would be subtracted out with it, but they don't have to be working on that. So we'll show you the form that'll help you walk through the calculation on that. And the other important part to note on this is for uh, resident retirees, and so you have to either have been a resident of Montana at the time you started drawing the military retirement, or have retired and then moved to Montana any point after June 30th of 2023. Um, so um, it was trying to attract folks to retire here and then keep earning some income with that. Then the last thing to note on this exemption is only for 5 years, for 5 tax years. So, and that's clock starts once you meet the requirements to do that. So anybody who's a military retiree, resident of Montana, if they're working, they can exclude portion of their income under this provision starting 2024. If somebody were to be eligible for this exclusion and then move out of state and establish residency for some reason somewhere else, they lose the exemption even if they move back within that 5-year window. So it's you have to kind of watch for meeting the requirements on that, but a pretty good benefit, I would have to say. So Montana has had the qualified endowment credit for quite a number of years, and previously it had been call it temporary. They put in sunset provisions, and part of that was because they wanted to make sure that they had it dialed in, and so they'd have to go in and not only extend it but could address any questions that may have come up in the interim. This last legislative session, they decided they liked the way it is, and it's now permanent. So um, you don't have you can plan on that for the near future. The other thing that they did was increase the maximum credit to 15,000 per taxpayer. So a couple notes I always like to make on when talking about this credit is that for individuals it is 40%, but it's of the planned gift, and so this is where you use the trust instruments in that to make a planned gift to a charity or something down the road. It's not for outright gifts. Um, for businesses can make outright gifts and qualify for the credit. They only get 20% of the value of the contribution. Um, but again, it can be an outright gift and they'll qualify for that. If an individual is a partner or an S corp shareholder in a business that makes an outright gift, that gift does flow through to them on their return at the 20% level. So that's the change to that one. Montana, for quite a number of years, it's been a discussion at the national level about, is it fair to tax people who are only in your state for a little bit and don't earn a lot of income in that? And so there was even some discussion, should the U.S. Congress get involved in that? But what Montana did is add what we're calling a temporary worker provision. And what that's saying is that if you're in the state to work for less than 30 days, 30 days or less, you do not have to report that income to Montana under a couple of conditions. Part of it is that you're not a resident. That's the main thing. Partially, one of the other requirements is that you also be performing services in another state. So the retiree who is a resident of, let's say, Arizona, and comes up here and helps out at the state fair for a couple weeks in one of the booths or something like that, they're not eligible for this because they did not work elsewhere. Now, if they did work something else down in Arizona, let's say, they could do that. So they could be qualified for that. So um, now some of the other requirements is it it doesn't cover people like professional athletes. So let's say NBA had an exhibition game in Bozeman. Those athletes would need to pay Montana on that. Entertainers, they're even if they're W-2 employees and only here for a couple of days, a couple nights, they'll still have to pay. Um, Anything that's on a per event basis, they're going to have to pay as well. Construction workers, they put that in there. Employees whose annual salaries are $500,000 or more, even if they're only here for a week, they'll still have to pay for that. And then if they're part of a production that qualifies for the media credit, they are not eligible for this exemption. It's partly because you're already getting their wages, maybe getting a credit already for the company, so it would be kind of a double dip in that. Now there were some provisions put in place to deal with the withholding on the employer side of it, some protections, and make sure that if they we're not going to penalize them if they follow certain requirements or certain tracking of the employees in that. We'll see, and you can read into those later if you're an employer um, or have clients who would might be eligible for this sort of exemption. Um, so that's the sort of new and changed legislation. Let's talk about some of the sort of procedural or year-to-year updates. Um, Here are your due dates. Um, the PTE is the pass-through entity form. That's due in March. Extended due date of 6 months gives it to September. Form 2 and fiduciary for states and trusts, that's due in April as usual. Uh, Common quick little note, only a couple dates are moved because of this, but for Montana, if a due date falls on a weekend or a holiday, certain holidays, um, it's moved to the next business day. And so that's why you see that the pass-through entity is due March 17th um, as opposed to the 15th. The 15th will be a Saturday and that. So estimated payments, any of you who have to make quarterlies or again have clients who have to make quarterlies, those are the due dates. The one that's not specifically the 15th is again in June. So we'll see that. Pass-through entities are subject to the same estimated payment requirement as individuals and estates and trusts. So they have those same due dates as well on that. And there's a lot of information on our websites about how you can make those and do that. So as I mentioned before, here's the new tax rates. This is for 2024, and this is ordinary income. So this is anything that's not the net long-term capital gain income. These are the rates that that will apply. You can see for single, married, filing separately, um, head of household, or sorry, estates and trust, it's up to 20,500 is 4.7%, and then anything over that is 5.9%. Uh, Married filing jointly and the qualified spouse will follow that as well. Those are just double the single rates. So at 41,000, and then head of household falls right in the middle. Um, MSA contribution, you can see that amount there. That's the amount that maximum amount you can contribute to a Montana medical savings account. That is, it was changed, but they did essentially maintain it for Montana as part of even though as part of the simplification in that. Um, This is another example of an instance when you might have to file a Montana return, um, even though you don't have to file a federal return. The Montana Medical Savings Account has a reporting requirement that you need to show us um, some of the ins and outs, even during the year, even if you aren't subtracting or that. Um, you will do that on the tax form now. You'll still have to do, so that's what you'll see there with that. I mentioned they changed the capital gains treatment from a credit to the new rates similar to the Feds. Um, Here's the rates, and just to further explain it, what you compute a tax first on the ordinary income, the non-net long-term capital gains income. You compute the tax on that. And then you come to these tables and these rates to compute on your net long-term capital gains. Uh, what that first box under net long-term capital gains is saying, where it says first 20,500 minus, is saying that first you figure out how much ordinary income you have, and then anything that's a net long-term capital gain up to the 20,500, when you combine the capital gains amounts and your ordinary income amount, is subject to 3% tax. Um, Anything where your capital gains and ordinary income are over the 20,500 is the net long-term capital gains are 4.1%. How does that work exactly? Let me give you a good example. So let's say you have $8,000 of net long-term capital gains. You have 15,000 of ordinary income. Okay, you're going to compute the tax on the 15,000 of ordinary income, um, and then subtract that 15,000 from 20,500. So 5,500 of your net long-term capital gains is going to be at 3%, and the remaining 2,500 will be at 4.1%. So again, it's compute on the amount of ordinary income first, then whatever net long-term capital gain would get you up to that 20,500 is subject to the 3%. Over that, it's 4.1%. If your ordinary income exceeds 20,500, all your net long-term capital gains are going to be at 4.1%. It's so that's a little simpler in that regards. Um, it's You can see that they do have those different levels for married filing joint and head of household. Um, so it's it's difficult when you first hear it, but it's almost identical again to what the federal computations are. And we have some schedules that look a little bit long, but really walk you through it step by step. And so we'll make it a little bit easier. So um, that's what you'll experience with the net long-term capital gains. And again, these amounts are indexed. Both these tables are indexed, and so they'll change year to year, and we'll see that in just a minute here. So, okay, I mentioned before, if you don't have to file a federal return, you don't have to file a Montana return. Here are the numbers that essentially the IRS says are the income filing thresholds for 2024. So if you're single, this is your gross income amounts are at these levels. The 14,600 for single, or if you're 65 or older. And this is essentially getting what's your standard deduction amount going to be with that. Um, Head of household, again, you can see it's a little bit higher. Filing joint, you've got that. If they are married filing separately, if they elect to or need to, basically it's you have to file a tax return if you have any income with all regards to that. So um, that's we provide these little bit of customer service, if you will. It's you can get those on the IRS as well, but we're just making sure that what we know what to expect in that. So interest rate. Montana's interest rates on unpaid tax are tied to some federal indexes, some federal rates. Right now for 2025, the individual rate will be 8%, and for basically everything else, it'll be 11%. Now, this is on the amount of tax owed during 2025. It's not specific to a tax year. So if you had someone or yourself were still paying on, say, a 2019 because you had a big gain and needed to get into a payment plan or something like that, during 2025, the rate on the unpaid tax will be 8%. So, um, and we release those figures usually at the end of the summer or so. Here's a little bit of tax planning for you. This is your ordinary tax rates for next year. The timing for adjusting those has it to where we know what it's going to be for 2025. So you can, again, plan your estimated payments if you need, double check your withholding, things like that. You can see at the bottom there what the exemption for 65 or over is going to be, and the maximum MSA contribution is at. So, and here's your table for your net long-term capital gains, same sort of thing there. So as you might expect with all these legislative changes, we needed to make some changes to the forms, and may not come through real clearly on your screen. We do have some options. We do have some links to some drafts of the forms and that. But I'll kind of walk you through it a little bit here on the change. First thing you might notice as far as a change is you don't see a field for dependents, because by going with the federal standard deduction, dependents don't matter. They give you the credit for your children and such. We don't have a need for those, for that information in there. We do start with federal adjusted gross income on line 1. Now, a couple notes on that. First of all, those of you unless you're new to it, you'll know that last year and previously, the Montana form started with line 1 of the 1040 with wages, and then went down and had you reporting all of that income. And one of the reasons behind that was that so many of those items had adjustments that we needed to see what the starting point with those was. Now with the change, and with more people filing electronically, we can get that information sort of straight from the 1040 or from other sources in that. But the other reason that we start with a federal adjusted gross income is because of that adjustment to your itemized deductions, if you're itemizing, that I mentioned earlier, which is adding back your state income taxes and that. So really what you're doing is adjusting the amount to put on line 2, and then you get to line 3, which is your Montana taxable income, and that's your starting point. We have lines 4 and 5 are additions and subtractions. We'll see those in a little bit here, but it's a lot shorter. And if you don't have any of those amounts coming from that Schedule 1, you don't have to attach that schedule. And I'll talk about that too. And then the 5,500 subtraction for 65 and older, that is on the front of the form. We wanted to say that if you didn't have anything else but had this, you could still file essentially just 1 or 2 pages, and then of the Montana form, or 2 pages. Then you can see we're not even halfway down the form, and you're at taxable income. So it's one of the benefits with this simplification. We were able to accomplish this, and so next line is your tax liability. There is a schedule for doing that that'll walk you through everything. You can see the non-refundable credits. Those, you'll put those on there. We have you break out where any withholdings are coming from. You get down to there. Down further, you got line 15, kind of hard to see, I'm sure, is the earned income credit. Again, that's where you'll maybe filing a Montana return when you didn't have to file a federal return. The 2EC is on there. And then you get into, we have lines for the contributions, for amended return information, and bottom of the page 1, we've got your tax due or your refund. So not quite a postcard, but it's pretty short with that. The second page is a couple things. This is where will do your computation of your tax. We start with the long-term capital gain tax. Just it's a little bit better to walk you through that one first, and that. And then you'll see in the middle of the page there your information for direct deposit or refund. There is an option if you have a 529 plan or the 529 capital A Achieving Better Life Experience ABLE accounts, you can put a portion of your refund to those and that. Then you'll see the signature page in that, and so that's the 2 pages that basically have only 2 pages essentially that are required. Schedule 1 is your adjustments. We still have a number of them, and as I mentioned, it's things that are either federally required or things that the legislature wanted to keep in that case. Middle of it, you'll see the military retirement exclusion. About 2/3 of the way down is your railroad retirement. That's something that's still in place, that subtraction. And at the very bottom of the page is the Montana Medical Savings Account reporting. Do that. So that's another one where, again, as I mentioned before, even though you don't have to file a federal return, if you have some activity in one of these accounts, you need to file the form to show us that. But aside from any documentation, these are the 3 main pages that you'll be filing with your return. So now Schedule 2, this is for non-residents and part-year residents, how they figure out what their tax liability to Montana is. Remember at the beginning I said we follow your federal filing status. So married couples who file joint will file a joint Montana return. That does include couples with different residency statuses. So one's a full year resident, one's a part year resident, or couples who are, say, non-residents, but only one of them has Montana source income and has to report. They still will file a joint federal return. If you have an instance with a couple where one of them isn't a full year resident, then you would still come here, Schedule 2, and report the spouse that has Montana income gets reported here in the numerator, and then down at the bottom is where you would see where they have the everywhere amounts for that. So it's including it in there, but we include the income, but then this schedule provides a ratio to reduce the tax owed to Montana to where we're getting a tax just on what is Montana income in that. The other thing to note on this is that with the different rates of capital gains taxes, we wanted to make sure that you didn't have a case where somebody who's a non-resident ends up paying a higher rate on their capital gains than the tables actually call for. So that's why we have 2 separate ratios being computed, one for the ordinary income and one for the capital gains on that. So that's where you would look to for that. Schedule 3, this is your tax credits. Again, it's a lot shorter. You do see some of these that have the carryover. Those amounts are going to be in there. The adoption credit is here on the refundable credits portion of it down at the bottom. So you would need to include this schedule as well as the form with your return to get that credit. And that's others. So, and then we do just have the one section for that. I'm sorry, for carryover credits Further on Schedule 3, this is if somebody is a resident but has income that's taxed in another state, um, there's a credit for that, eligible for that. So this portion of Schedule 3 is where you compute that. Because you could be having different tax amounts related to capital gains as opposed to your ordinary income, that's why there's the two separate calculations with regards to that. And so if you're taxed on your capital gains in another state, we make sure we get the right credit applied to you there. Schedule 4, this is, again, not a required schedule necessarily, but may be necessary depending on your circumstance. Starts off with the portion where you can contribute a portion of your overpayment to any of these different funds, and that report what your calculation for underpayment of estimates is in there, or to indicate that you annualized or you're using the farming income exception. A note on the late file, late pay interest calculations. We use our system does the calculations, so really those lines are just to say, here, figure these out. A lot of the software does a good job with those, but figure these out, and then this is how much you might owe for that. If it's off, we do apply payments to tax first. So as long as the tax is paid off, if your interest calculation, let's say, was a little bit off, and it was important enough, we'll send a bill for the interest. But as long as the tax stays paid off, it's not that interest amount isn't going to go up. It's just to the point that you paid it off. And so that last little schedule, you probably may not have to use much, but is on, if you have to amend the return, this is where you would indicate some of the information on that. So 2EC, there's a few more lines to get some of the different types of income included in here. And then we're trying to get a little more information about what comprises the household. The 2EC, although it's one person claiming it, it is based on the situation for income and such of the household in general. And so we want to make sure we're getting the whole picture on that. And so that's why you see some additional check boxes and a little bit of additional information asked for in this. If somebody does not have to file a federal return but wants to claim the 2EC, they will file they'll file the Montana return and pages 1 and 2, and then attach the 2EC form for that. So that's what you've got there. So in going from different types of calculating income, legislature was presented with situation that some taxpayers may have essentially different carryovers or different basis in some items because of the way tax was computed in the past. The primary reason behind that was married couples filing separately for Montana that filed joint federal returns. For a period of time, it was different amounts that were allowable to be claimed on the returns. And so these couples may have passive losses that were suspended on Montana return, or excess capital loss carryovers because they couldn't use them on the Montana return, and that. As part of Senate Bill 399, the simplification bill, they provided for a one-time sort of catch-up, true-up, if you will, on the whole thing. And again, it's primarily with passive loss and capital losses. There's a few things, certain assets could have a little bit different basis, and so you true it up for that. Those are almost exclusively coming from these capital loss or passive loss carryover differences, so that could be part of what that is about. So that's what you might see that. It's we're at a point where there's very few that even had these differences anyway, and I'd almost expect that we'd have probably fewer people legitimately claiming these than are on this call right now, so, or on this presentation. So it's fairly, but if you have the paperwork to show that we had these differences in the past and can claim it by all means do so. If you have any questions about these in particular, or you're not quite sure, please do give us a call. That's We're always happy to discuss these and understand what we might be seeing when we start getting returns in and that. Um, the bottom half of this transition schedule is the federal taxable federal refund. Previously, the Montana legislature had allowed for federal taxes to be deducted as an itemized deduction with a cap on them. And so under the tax benefit rule, if you received a refund, you had to add it back to your income in that. Senate Bill 399 did not keep that deduction for federal income taxes. Um, so going forward, you really won't have to worry about your federal refund and whether it's going to be taxable on your Montana return, except for this first year of the change, because you could have deducted it for your 23 return and received a refund in 24, and so that would be potentially taxable to Montana at that point. So this is where you walk through it. The calculation is the same as it was in the past, just it's on the form there. So fiduciary return changes, a little less common filings on this, but we'll talk about it. It was impacted by the simplification as well, in that you start with federal taxable income for estates and trusts, including what the exemption amount that they're allowed federally is. We no longer have the one exemption amount for trusts and estates, just the federal. But with fiduciaries, it's tricky because of distributions to beneficiaries. And then when you talk about your state filing, you also have to deal with some of those adjustments, additions and subtractions, and the sourcing of it, keeping track of that. And so the FID 3 has a fairly significant overhaul from the previous one. It looks a little bit tricky, if you will, or it's kind of a lot of ins and outs, but I think if you stick through with it, it will it'll guide you where you need to be with that. So there's what that looks like. On the payments and credits portion of it, you have the situation with these estates and trusts where there's certain income that's coming into the trust that's subject to a withholding, either mineral royalties, some sort of pass-through withholding, et cetera. But then the income could get distributed out to the beneficiaries and not be taxed at the trust. Well, we wanted to make sure that the withholding follows the income. And so what we have here is that you report the amount that came into the trust as withholding, and then just below that, then you say, okay, this is the much that we allocated out to the beneficiaries, and so that it's not kind of prevents it from being double claimed, and also keeps it with the income in that. So but that's the effect of these changes. Wanted to get going with some of this. The tax calculation, it is also subject, fiduciaries are subject to the same net long-term capital gains tax, so that computation is in there. You'll see that on that form there. And we have the totals for these additions and subtractions, and helping with the sourcing. That's what Schedule 1 is about. Schedule 2 is for what you would call a non-resident estate and state or trust, for them to compute their income in that. So um, hypothetically, a trust could pay tax to another state, and so they get that same credit, and it's got that same situation of net long-term capital gains and such, having different tax rates in that. So that and one function sometimes of a trust is the small business trusts. They compute another tax altogether on their own. That's for employee stock stuff. So the K1, it was revamped to, this is what the beneficiary will use to complete their Montana tax return based on as relates to the trust income. You've got some boxes to check in there, and then the trust will report the different types of adjustments, different types of income, and their sourcing in that, and subtractions. You don't see a lot of that with the estates and trusts, so that's why the part 7 down there at the bottom is just this detail that goes into part 3, and you just using some codes in that. And so little bit hopefully it makes it easier for folks to track. Those are the changed forms. Here's some new forms that I talked about. This is the working military retirement exemption. You can see how that's going to function. There's the two parts. There's the one for the working retiree, and then you have the part 3, which is the survivor benefit exemption in that. So, and that'll gives you some good information and good guidance on that. Small little change. As I mentioned before, with the pass-through entities being subject to um, being subject to the estimated payment requirements, um, we have to have a little bit different form for them. It's important because a couple years ago they implemented a new pass-through entity tax, and that's a whole nother presentation that we can talk about um, later. But it's there's a lot more pass-throughs, partnerships in that filing this PTET. They may have reporting their income on an annualized basis, which means it's not consistent throughout the year, or it needs to be aggregate averaged. They can use this form for that. So it's a little more specific. It worked on the old form, but this is just a little bit better, a little more detail specific to them. And the last form to talk about, it's new. It does sort of replace an old form, the DER1, as you can see there. And what that is that's a DER was for the disregarded entity. So that's some sort of entity that's its own thing, but it doesn't pay any taxes. The taxes flow through to the owners on that. So that's why it's considered disregarded for tax purposes. We changed this to just have this be the form DE. It helps us track when the income goes into this entity, where does it ultimately go out to and who's responsible for it. The other part is that if this entity is operating in multiple states, it's subject to apportionment of its income. And this provides for the computation on that. So quick note, Montana does go to what's called the single sales factor for apportionment of business income starting with the 25 tax year. That's just something to keep on your note board in that. At the very bottom, one little thing to talk about is we do have in statute what's called an alternative tax method, or alternative gross receipts tax. It's really an uncommon thing. It's basically for somebody who has a little bit of sales into the state and has enough activity that they have to connection to the Montana and should be filing, but not enough to go full blown with like a pass with a corporate return or something of that nature in that. And so they're permitted in there's certain circumstances to pay 1/2 of 1% on their gross sales up to $100,000. But again, I'd caution anybody to if they think they might be eligible for it, they're, to be frank, you're probably not. It's very uncommon. So with that, so those are the updates we wanted to talk to you guys about. We've got about 4 minutes here before the end of the hour. I'm gonna turn it back over to Jason and
yeah, we're trying to catch up on some of the question and answers. And Rachel is writing some of those answers out as we speak. Let me just ask you, Myra had asked, does foreign tax withheld on investment income qualify for a Montana credit?
I'm looking at it. I would say, based on what I'm reading there, it would not on that. But I guess I'd have to. That would be something they could shoot us an email, and we'll could get a little bit more of the detail on that. So
let's see. Will there be, oh. I missed, will there be any relief to late payment penalties due to the massive reduction to withholding and the elimination of married filing separately on the same form?
That's not one that I don't know that is, I can give you a good answer on. People can apply for reasonable cause waivers in that, but we did have the new withholding tables out earlier in the year and that, so
Did you skip over page 18 of the form PTE?
skip over page 8. I'm not.
Did you go over?
We did not include a discussion of the PTE form in this, until aside from the change for the annualization methods. So I'm not familiar with what that page 18 would be offhand anyway. So
awesome.
Yeah, I think. Yeah, I think we're getting kind of in the weeds a little, and I appreciate the questions. I love the tax, but I think we're getting a little. I don't want to ignore anybody, but maybe it's better if we can get some emails. Kind of an easier way to handle some of these. So.
Do you have the slide that has the email that you'd like someone to send to? Would you like to?
Yeah, let me put
so everybody.
It's got that still up. So.
And just so everybody knows, I can look at what the question and answers are. As long as someone isn't an anonymous, we can follow up and say, hey, you had Gigi, you had a question about Air Guard. Does it count for military credit? If we have to follow that up, we can find you. It's a little bit harder when if you log it as an anonymous attendee, then we can't find you. But as long as you are giving your name, we can sure track you down. Okay, yeah, so it is high noon. I want to be respectful of everybody's time and make sure everybody has the ability to get back to their day, what they were doing beforehand. Once again, Brian, thank you so much for giving this presentation. This is going to be a big year for a lot of changes, and it's really nice to have this presentation. Rachel, thank you so much for being on the back end of all this. And we look forward to seeing you at the next one. Also want to give everybody just kind of a quick heads up. We will be putting this video out there, but it will be about 24 hours or so. So if you give me a little bit of grace there, I can get it on our website. In the meantime, please use those email addresses and we'll get you some answers to your questions if you email us. And other than that, have an awesome day. Thank you so much for spending it with us. And we will see you next time.